Okay, webinar is now live. I want to thank you guys for tuning in, and we have a distinguished guest. I mean, really the premier attorney and just expert in the syndications world in the commercial real estate business.
Can't wait to hear who that is. I'm excited.
Well, none other than the Gene Trowbridge. Thank you, Gene, for joining us today. I know you're extremely busy, so I really appreciate you dedicating your time to come to our little group and talk a little bit about syndications. We are really, really excited. Thank you so much.
I'm happy to be here. As you know, I listen to your broadcast periodically, and I heard one the other day on 1031 exchanges. I wanted to compliment you on the. That's a hot topic even in the syndication world, because a lot of people who bought properties at the beginning of this cycle, which I think was maybe 2012, now have quite a bit of equity. And the syndication, the group, is trying to figure out what to do with it. And the members in the group are trying to figure out what can they do, how can they defer gain. And some people are old enough that they don't want to go into another property. So it's all very complicated. And I thought you had a good explanation of that. So I'm happy to be with you. Let's do something good today.
Yeah, absolutely. And I think that's what it's kind of all about. As you talked about, people who bought in the beginning part of the cycle, right? And they've got a ton of equity right now. We are in a pretty unprecedented, for lack of a better word, situation with the pandemic. And here in the Bay Area, it's a mixed bag. Single family homes are still going through the roof in terms of home values. Office and retail properties, sitting apartments, it kind of just depends. So people are just trying to figure out which way is up. And I think the more quality content that you can absorb, that's kind of the best thing you could do, And so having you on is huge. And if you don't know who Gene is, you've got to do your research. He has wrote the book, literally. It's a whole new business on syndications. And you got to get that book if you're serious about this business. So, Gene, first of all, I wanted to ask you, you're a real smart guy. And Gene also is a CCIM, which, if you don't know, stands for Certified Commercial Investment Member. You got to learn some things, take some classes, but you got to also do a lot of business. So you could have gone different ways in this business. What was it that, moved you to kind of go into the syndications route?
Well, that's right, Steve. I started out strictly I got out of college and started out strictly as a commercial broker, Steve. And while I was doing that, I got my CCIM designation. And like many syndicators, and this is one of my 2 or 3 favorite slogans, if you don't have enough money to buy all the real estate you want to own yourself, you're going to have to get money from other people and pool investors' cash. And that's where I started. I bought my own house, and then I'd bought a couple single family rental houses. And then I didn't really like that management business.
Yeah.
So I said, what if I buy an apartment? I found an apartment. I couldn't buy it myself. I reached out to 3 guys I'd gone to college with. We bought it. We bought an apartment building, and the rest is history. I moved to California at some time and decided I wouldn't start up a brokerage practice out here. I would start up full-time in the syndication business. So I did that for 15, 16 years. And then one thing led to another. It was time to do something different. And so when I was 45, Steve, I went to law school. Wow. And I only had one reason to go to law school, and that was to become a syndication attorney, to continue mentoring and helping people, which I taught CCIM classes for 40 years. And so I know a little bit about teaching and mentoring. And I thought, well, if I didn't want to be a syndicator anymore, maybe I could still stay in the business and help people. And so that's been a great change for me. And it's been everything I thought it would be. And luckily, myself and the 3 partnerships I've had over the years have been successful. I've mentored a couple ladies who are partners of mine who have gone on to be successful and own their own practice. And I was happy that I could do enough business for all of us to keep us going while we were mentoring and learning.
Right.
And that's great. So now I'm into my third mentoring assignment here. And Jonathan and I are doing great in the first 90 days of this new partnership, Trowbridge Law Group.
Wow. And you mentioned mentorship and teaching CCIM. So again, if anybody's out there interested in commercial real estate, I think the CCIM curriculum is second to none. So when you sit there as a student, it's like a fire hose of information coming at you. But I would imagine as an instructor, you really got to prepare to put all that information together and get the
Well,
word.
that's true. But I'll tell you, the fire hose works both ways.
Right.
You get a class of, 35, 40 rabid people trying to challenge you and say, what can you teach me?
Right.
How are you going to make me better?
Right.
You're on your toes.
Yeah.
And the Institute's material is great. The program is great. I just always was happy. And I always had thought that as an instructor, I just didn't want to get in the way.
Right.
Okay. It's good stuff. Let's lay it out there.
Yeah.
Well, they taught me how to teach. I'm now teaching the students how to be practitioners, and I thought it was great.
Well, because you mentioned mentorship, and that's why I brought it up. And because so much about the CCIM curriculum is technical, investment knowledge, numbers, all of that. What I've gained from not only taking the classes and the designation, but being a part of the leadership is, kind of how to lead. And then also how to teach. I've got 18 agents that work for me in my brokerage, and I've been around since November 2009. I have learned a lot, and what I figured out is I don't know what I don't know. And so it was that institute, having somewhere where I can learn from other people helps me out to be able to teach and mentor. And
and you met a lot of great people going through there.
Oh, yeah.
Didn't you? As a syndicator, I didn't have much opportunity to really do a lot of business with the students. But I know a lot of the great instructors who are just straight brokers and were able to take their brokerage business around the country with students that they met in different markets. That didn't help me, but the other thing that helped me is there were a lot of people who wanted to learn about syndication, and I developed what I call education-based marketing.
Well, I
That's
think
taken me where I am.
Well, I got into business first. I ordered a course by a guy by the name of Carlton Sheets. No money down real estate.
Sure.
But I went through that course, and because, a lot of the courses you get, they're all right, but his course was really good. And what I learned from that was that education is a key as a practitioner, as an investor, as a professional. And you talk about mentorship, which I think is great. I'm going to ask you a question about your book, because I've read the book twice. It's made a big impact on me. But just before we go into that, what is your favorite part about the syndication bit? I was going to ask you, because obviously it's a passion of yours. It's obviously something that you're great at. What is the one, and I'm sure there's some things you work through in the business that's like, but what is that thing that kind of, when you're working on it or you come across it, it gets you going, gets the juices rolling, and makes you say, hey, this is why I love what I do?
It's the first time syndicator. It's the rookie.
Yeah.
That's what, I've got a client I've done 110 deals with. Okay. So, that's great money.
Yeah.
Please.
Yeah. Right,
all the same, but boy, get a rookie. In fact, I was on the line telephone call this morning with someone who's thinking about buying a building in Santa Ana that he won the rights to in a lottery.
Oh, wow.
That's going to house a cannabis dispensary. Okay. I'm learning stuff about that all the time. How are we going to finance that? Well, we're not. Well, how are we going to raise enough money to go on cash? So that's really exciting. And then we get the deal closed, and I get the call that, we did it.
Yeah.
That's exciting. Nothing wrong with doing 110 deals and building a net worth, from it. But really, and in fact, I'm going to do we're going to do a live educational webinar in the month of September, only for rookies, Steve. Haven't even started marketing it, but I'm going to do 2-3 hour classes, and we're going to charge for it.
Yeah.
And you can't, I'm going to do the best I can not to have anyone who's on a deal sit in the class. And we're only going to have 15 people.
Well,
so
I hope the listeners,
juice is flowing.
I hope people who, as I know, there's a few people that are on right now that are in that boat. And I hope you guys are listening and you take advantage of that, because it's golden. And you got the premier expert in the space talking about what gets you going is the first timer. And I think that's
exciting.
It is exciting when someone buys it, like with me, when I get somebody for the first time buying an investment property. I got an apartment building getting ready to close, and it's a nonprofit that owns it. They got many buildings, but the ED, this is executive director, just one of her first major acquisitions of an apartment building, and she is on the ball. And I've just seen this whole process. We hopefully close tomorrow. And she's excited, man. And that excites me because sometimes, like you said, you work 100 deals with somebody, you kind of get in the in the trenches of what you're doing, but it's that first timer when their eyes light up and that your eyes light up. And I saw you guys who are listening take advantage of that. So with that being said, let's get into the book a little bit. And it's a whole new business. And I know there's a couple different versions because of the Jobs Act. You updated it. First of all, what inspired you to write the book? And by the way, you guys, that book is the standard on syndications in the United States. And I would venture to say in the world, but certainly in the United States, in the commercial real estate business, it is the standard. So,
and Steve, if I sell one more, I can retire.
Well, hopefully you sell a few more, after this, because I literally, it's a big book. I've read it twice. I've learned it. I plan to read it again, over this next few couple of months. But every time I read through it, I learned something else. And so,
Steve, to answer your question, the reason I wrote it is that real estate people, which is my marketplace, salespeople and brokers and mortgage people and appraisers and whatever, they don't understand that when you put a group of people together to buy something, you quickly leave the real estate world and you enter into the securities world. Right. So I don't think in my book more than 5 times I refer to cap rate or NOI. I don't do anything like that. I don't talk about the real estate because all the people that I wrote the book for, I thought would have already learned real estate on their own or from someone else, but this whole new business of the securities laws, because I think when you're a syndicator, you're much more in the business of managing people than you are real estate. I mean, I don't know if you do any real estate outside of California, but almost all of my clients do real estate somewhere else, and they have property managers and all this. So they're really in the business of managing 20 or 30 people in an investment. And in 5 or 6 years, Steve, 20 or 30 people, there'll be 1 or 2 persons in there who will have an event in their life that needs some attention. And they come to you because you've got their money.
Yeah, absolutely.
So that's why I wrote the book. And,
well, that's amazing.
You know Bob Rosenberg from up there.
Oh, yeah. I know Bob real well.
Bob dared me to write the book. In 1996, he asked me to come to Reston and do a presentation on syndication. Wow. And I said, well, no one is going to come to a national CCIM event and do a breakout session with me. And we had to expand the walls and bring in new chairs, more chairs. It was just an amazing turnout. And he said, these people are starving for this. Why don't you write a book? And in those days, there was something called the Advanced Education Board, and we were looking for things to present to CCIMs that were not covered in the designated courses. And at that time, we only had 4 pages in 104 on syndication. And I said, well, I can do a product. I'll write a book. And we'll sell it to the Advanced Education Board, which is now the Ward Center.
Right.
And that's how it came. I couldn't believe how many people have bought my book. It's really amazing. It's a business card, Steve. It's a business card. If I could get everyone who's a real estate agent in the United States to have one of these on their desk, it would be great for my business. But anyhow, that's how I got there.
Well, and it's, I mean, if you've taken the time, again, if you listen to this, get the book. And what I think what you mentioned for the real estate professional, when you put a group together, you're right. You do leave the real estate world and into their securities world. And I like what you also said about managing people more so than the property, right? So, I mean, that's a big part of business in general, whether you run a residential brokerage, commercial, you own a retail shop, you're essentially managing people, which is not the easiest thing to do, which is,
and what you're doing here in the syndication world, Steve, is you actually, I'm going to say this, you actually take their money.
Yeah.
Which you don't as a broker.
That's right.
Now, you really don't as a syndicator because the money goes in the LLC that owns the property, but it all flows through you and everyone thinks, Gene's got your money. Gene's got my money, So that really isn't the case, but you're treated as if you have their money. The fiduciary duty is extremely high. We're always concerned about misrepresentation and fraud and disclosure. And so it's a little different business than selling a building.
Absolutely.
And, delivering the keys to the new owner and getting your commission check. It's just a little different.
A little bit different. And I think that that's important because a lot of agents, brokers, people in the business are wanting to get into this as a method of developing an investment portfolio, retirement, because, there's not typically at your brokerage is not going to give you a 401k, retirement plan, right? So you got to invest, but it's having that guide because it is a different business. It is a different shift. And it's like, if you got your real estate license, there's the education you need to get your license, but then there's the education you need to run the business. And that's why having your book and being in contact with you is absolutely critical. Now, that being said, let's say someone is saying, hey, and by the way, I see a couple people raise your hands. We are going to leave about 5 to 10 minutes at the end of the presentation or the discussion really to answer your questions. So I do see a couple of you guys have raised your hands, have questions. We will get you. We're just going to come at the end. So just save it. At the end, we'll look at the Q&A in the chat and we will address your questions for sure. Now, for the first timer, right? Say they've resolved, I'm going to put together a syndication. They've got the book. They've got the baseline information. What are some of the key first steps that they should make in terms of, all right, tackling this whole business?
Well, I think the first step they should make is to find a partner to do this with. I think the first question an investor should ask is, Steve, I like your deal. I can give you the $50,000 for my investment, but Steve, what happens if something happens to you?
Right.
And if Steve can't answer that question with some sort of a continuity plan, I'm going to advise people not to invest with Steve. Now, it doesn't mean Steve's going to die, but there are a million things that can happen to Steve.
Right.
And when we have an LLC as the managing member, and there's only one member in the LLC and something happens to that member, the LLC can't conduct business.
Right.
In fact, in California, if the member dies, the LLC is dissolved because you have to have a member to have an LLC. So you should really have 2 people, the banks like that, and on and on. Yeah. So that's the very first thing I should think you should do. And then, you should be working on your database because more than likely your first couple deals, Steve, you're going to raise money from people you know.
Yep.
So let's get that database going. And then the third thing I tell people is to make your first offering a specific property. Buy that apartment building over there or that mini storage over there. It's an easy story to tell.
Yeah.
to the investors. You don't have a track record, so you can't do a blind pool. So make your first one a specific offering and make it a success. By that I mean you find the property, you get it in escrow, you hire the attorney, you get your paperwork done, you raise the money, you close, and at the end of the first quarter, you send out your first quarterly report. That's a success.
And man, that is worth its weight in gold. You know, just to recap, get a partner who's going to be in the trenches with you, which is very, very important. That's, I think, critical. And I'm just hearing you say that makes all the sense in the world. And then work your database. So that's something that I teach and preach to my agents. We have our sales meeting, leadership meeting every Friday. And I probably say that every Friday is the word, just for selling real estate, because most of your business is going to come from your network. And, you know, it's real good to hear you say that. So, you know, that's a key piece, because a lot of people meet people and they never go into a database. They're just out in space or in the phone. But having that database is really valuable. And then making it a success, doing all that work, getting together. Now, I like what you said. First quarterly report, that, you know, get it together and then report out to the investor. So that seems to be something, my experience in doing a couple of these syndications, that is very, very important to investors. And what I learned the hard way when I did a couple of deals is that you have to stay in contact with people, even when there's really not much to say. Sure. You know, because like what you said, they've invested with you, even if things are going great. If they haven't heard from you for a while, they just don't know. And so that's, I think,
you've got their money. That's what they're going to think for forever. So the first question you should deal with as a syndicator is continuity.
Yeah.
And then the second question you're going to get from the investors is, Steve, have you done this before?
Right.
And we've all had to say no.
Yeah.
Once. So that's why getting that first deal done and getting it to be a success, it's so important, because then you can say, well, hell yes, Steve, I did this once.
Yeah, look at these results. Right.
You've got to get by that. And, you know, if you haven't done a syndication, what have you done? You've been brokering properties, you're a CCIM, you're educated, you're working with people all the time. That's great. There has to be something in your past that is going to instill confidence in the people who invest in your first deal, because you're not going to get anyone who doesn't know you. People are going to take, and I never use the word sell. People are going to take a chance on being part of an opportunity that you've identified and invest their money with you. You don't sell 10 units in a limited liability company. You sell people on the opportunity to be involved in this building. You've identified an issue with this building. Some may be problem, some may be opportunity that you can solve if you could just get a hold of that building. And if you do, and you're with the team you've put together, you can solve that problem, you're going to make everyone a lot of money. And people who know you want to be part of that opportunity if you give them a chance.
That's
Is that smooth?
That's real smooth. That's great. And I mean, you just kind of, in its essence, describe the value of a syndication. Now, real quick, you mentioned something I think a lot of people need to pay attention to. You mentioned, especially on the first one, you want to do a specific property versus a blind pool. Can you just maybe elaborate on that? Well, like, first of all, some people may not know what a blind pool is, and then a specific property.
Sure. A specific property is, we're going to buy that apartment building over on Stockton. Okay, good. Here's a picture. Here's a pro forma. Here's the package. Great. The alternative is, you know, I've done 40 of those properties like that one on Stockton, and I'm seeing the opportunity. Maybe if I had cash ahead of time, there might be some blood in the streets. And as an acquisition strategy, if I've got the cash and I see an opportunity, I can compete with the all cash buyers. I can compete with the 1031 exchangers. I can go into a bank and buy an REO and prove up funds.
Right.
but I'm going to buy more than one property. Let's buy 5.
Right.
Let's raise 25 million, and I think it's going to take me 5 million in each property, and let's buy 5. I have no idea where the first one's coming from, but here's my track record of 40 deals, and they've all been, in the Bay Area, and they've all been 10 to 40 units, and that's what I'm going to buy. I'm going to buy 10 to 40 units in the Bay Area. That's it. I'm not going to go off and buy RV parks.
Right.
That's not going to do it,
Right. And so that was the importance of the first timers needing to stick with the specific property, because if you starting out, you don't have that track record of, I've done all these type of deals. Mm-hmm. So it's hard to, and the reason I bring that up is because a lot of people here, at least I know in like the, in the venture capital world and just the, hedge fund world, there's a lot of funds going on now. There are opportunities on funds, and a lot of people, wanting to start out, just go raise a bunch of money in a fund. And I think that's a challenge, because people will say, well, what have you done before? And I think that, when you're raising that kind of capital, you are competing against the guys who, I did 50 deals here, 100 deals there.
Right.
So when you're starting, you got to look at the sticks and bricks, that property where, hey, we can look at and say, the economics of this building is worth investing in because of the cap rate, the cash on cash, so on and so forth. The economics of that deal versus essentially your track record, if you will, in that property, which. And
so then when you get into doing the securities, which I don't think we're going to go into there, but there is part of the securities world today that lets you advertise for investors. That's a dead end if you don't have a track record.
Right.
So if you don't have a track record, don't do a blind pool and don't do a 506c. Just stick with a specific property and raise money from people that you know. And in your first offering, my experience, Steve, is if you set the minimum, let's say at $25,000, you're going to get everyone to invest $25,000 because they're going to try you out.
Yeah.
So people say, well, let's set the minimum at 100. Well, that might be too much of a gamble. Plus, why wouldn't you get a lot of investors at 25 so that you build your database of actual investors who will invest the second time because they've got more than 25,000. They just don't want to give it to you all on the first time.
Right.
And they've got friends that they'll refer you to. So I tell all my rookies, your first deal, let's get 10, 15, 20 investors. Let's build something. Don't do it with one guy who can fund the whole deal. That doesn't help you.
Right.
Your goal is to be a syndicator. I mean, that might be that might be your business strategy. Okay. I'm just going to go out and help people that have a lot of money, but no time and no expertise. And we're just going to do joint ventures one-on-one. Fine. That's a strategy, but that's not necessarily what we're talking about here.
Yeah. Because that's a great point, because usually in that situation, when you do that, the party putting up all the capital typically is going to be running the show, and you're just doing a property management, asset management, whatever. But you're really almost dependent upon them. Versus if you do a syndication and you put your efforts together and you find a way to consistently get investors, now you've become more valuable in the marketplace. It would
right. And those big hitters don't need you. After 1 or 2 deals, they can do it themselves.
Well, exactly. And I think that's the key. And thank you for breaking that down. And so you guys, that's a huge part of syndications is the specific offering versus a blind pool. Gene has broken that down specifically. And now I wanted to ask you, so we're talking about, the first timer gets educated, finds a partner, looks through the database, gets some investors, they get a deal. What are maybe some of the pitfalls that people need to look out for? And at first, and I think that having a team is critical, the right attorney, right brokers, mortgage folks. But what are just some of the pitfalls that you see a lot of first timers falling into that maybe folks should be aware of?
Well, someday I'll come back and I'll do a session on mistakes that I've made and I've seen other people make. But for right now, at this time frame, one thing is to give yourself enough time. It's going to take, I'm going to say 60 days from the time you enter a purchase and sale agreement until you can close. Those 60 days We'll give you a chance to do your due diligence, to get your financing, let your attorneys draft the documents, and hopefully still give you about 30 days to raise the money. If you had 90 days, it would be better.
Yeah.
But 30 days would work, as long as the minute you go into escrow and you've hired the attorney to start the paperwork, you start, and I hope you're given this advice, that you can start talking to people with whom you have that pre-existing relationship and tell them that as something is coming down the line. I always try to get my clients to develop maybe a 1 or 2 page marketing piece that they can use right away with their existing clients and say, you know, here's the picture, here's what it is. It looks like we're going to have to raise $3 million and it's a $25,000 minimum. I'll have more information for you later, but you know, keep your money liquid. Yeah. Because when I come to you, we're going to want to invest. And if you're thinking of moving some money into a self-directed IRA, let's get that going right now.
Right.
Because we'll need that money there when it's time. So, Steve, not giving yourself enough time is a big deal.
Yeah. And I think.
Go ahead.
Well, I was going to say, I think a lot of people probably make that mistake because you're competing with other offers that are saying, hey, we can close in 45 days.
Yeah. Well, not every deal can be syndicated.
Good point.
You know, it just, not every deal, and not every person's a syndicator too. I kind of think that a syndicator needs to have an idea when they start a property, when they start their offering, on how they're going to close, just in case they run a little behind in their money raising activities.
Yeah.
Because the worst thing you can do, especially in your first deal, Steve, is to give people their money back. I mean, that's fine. We didn't get it done. Here's your money back. Good. They didn't lose anything. But the next time you go to them to do another deal, they're going to say, well, Steve, you know, we didn't quite succeed on the first one. I'm in. Steve, I'm in. I'm going to invest with you. Yeah. But I'd like to see if you can find some other investors first.
Right. Right.
You need the people that know you the best. That's why your first deal has to be a success. When I was raising money, Steve, I was raising money through the broker-dealer community, through people who had securities licenses. And the companies who did the due diligence on me and the project always insisted that I show them the liquidity needed to close on the escrow before they signed a selling agreement with me. Because they didn't want their people, their reps, to go out to their investors, get the money, put it in the deal, go through all the paperwork, and have the deal fail, and now have to give the money back to the investors, and I'm still liable for the commission. Okay, so I had to have X number of dollars on every deal and show them at what point I could step in and get the deal closed. Now, we were building self-storage, so what we were trying to close was the dirt. Okay, so I really had to tell them I had enough money to buy the dirt, and then construction loans and all that other stuff. So whatever it takes, and that was how I did business. So giving yourself time, that was another one. I think that not reading your documents. You know, you're going down your 60 days, and here you get the documents, and there's 30 days left to raise money, and you just want to go out and hammer Steve over the head to get his money. Yeah. I got the documents. It's 12% cash on cash. You got to give me the money today.
Yeah.
Well, heaven forbid Steve reads the documents and asks you a question. You better know your documents better.
Right. You're like,
you know they do that, right? The most inexperienced person will look at a purchase and sale agreement and go to some boilerplate language and ask you to explain it, Steve. Yep. And where did this guy come from, you? Please.
Yeah. Well, I mean, that's funny you said, because that's also in brokerage as well. Yeah, you know.
Oh, absolutely.
Agents do. They got to get familiar with the contracts. Because, you know, you don't have to know every single word, but you have to be able to know what you're having them sign.
Yeah, and you have to know where to find it. You know, people will ask me, see, the first question that I think people need to know is this continuity question. And then, have you done it before? And you can tell them, yes, and my track record is in the document, or it's the exhibit to the document. And then the next question is, are you going to invest any money? Steve, are you going to have any skin in the game? And you need to be able to answer that question. And Steve, you know, I've done a real turnabout in that question. When I was a syndicator, it was always, how much cash are you putting in the deal? How much cash? How much cash? Today, everyone is aware that not only do you put some cash in the deal, but you sign the mortgage.
Right.
And sometimes you have to go out and get a key principal to sign the mortgage with you, and they won't do it for free.
Right, of course.
So why should you do it for free?
Right.
So I'm not worried about doing it for free, but I'm worried about telling people, well, yes, I do have skin in the game. I just signed a $3 million recourse loan.
Well, that's some skin that's in that game for sure. You know?
Yeah, that's skin in the game. Now, what do you think? So that's good. And then the last question the investors ask, and this gets to the point of, have you read your documents? The investor says, well, Steve, what happens if something happens to me?
Mm-hmm. Oh,
is this liquid? How my wife and my family get, you know, how does this work? And Steve, you need to know that Article 11 and Article 12 in the operating agreement cover the liquidity provisions of whether it's a voluntary liquidity or it's by some sort of act of law. And you need at least to be conversant enough to go through that with your client.
Yeah.
So you can't say, I don't know. You know, that's
yeah.
trouble. So not having enough time, not having continuity, not reading your documents. And I think the last thing is trying to get rich on your first deal.
Yeah.
I think on your first deal, you have to be conscious that you don't have a track record yet. You are going to make money. When's the best time to make money, Steve? When your client makes money.
Right.
Okay. We're not going to front end the acquisition fee. We're going to split cash flows as it comes out. We're going to split refinancing proceeds. We're going to split sales proceeds. You don't want to be ridiculous. The fellow I was talking to about the cannabis deal this morning wanted to do a 90-10 split where he gives the investors 90% of everything and he only takes 10. I said, why would you do that? Well, it's my first deal. I said, that's not going to make money raising any easier. That's just going to make people think you don't have any confidence in yourself or the deal. I said, you need to step up to at least 80-20. And that was just and based on the deal. I mean, we're buying a free and clear piece of real estate at a 14 cap. So come on.
Wow.
You want to give them a 6% preferred return because you feel bad. That's fine. Do that. But you know, why is the cap rate so high? It's because it's cannabis. It's a weird.
Yeah.
So,
but
so I don't think you want to be. You don't want to be afraid, but you don't want to take 50% of the first deal. You're never going to get rich on your first deal. It's going to take you 5 or 6 deals to have an income stream coming in, Steve. And then the first thing you're going to do with that is to hire an assistant, because you're going to have 60 investors who are calling you and asking you, and you got a brokerage to run. So you're going to need an assistant.
So wow, that's really a good point. Especially you said the guy was 90-10. Is the 80-20, is that a good start ratio, or is there a standard start?
Yeah, I wouldn't start any lower than 80-20. 80-20 would be fine if there's no preferred return. I think the more the preferred return goes, the more you could go to 75-25, 70-30.
Yeah.
You can increase what you get, because all it really is a split after they've been paid first.
Right.
So it's somewhat marketing. I mean, the guy's got a 14% cap rate, so and he's buying it free and clear. What is a 6% preferred return? It's nothing. It's a guarantee almost.
Right.
We don't call it that. So why didn't you say, and I'm going to give you 6% up front? Okay. We're talking a little salesmanship here.
Yeah.
Okay.
Well, I mean, okay, so
Okay.
in that vein, right? Because that would be a real good deal. And I think if he talked to 5 or 10 people who would have had the dough, they might even fight over it, right? They might.
Well, you know why that might not be a good deal is I don't want you to have to read the risk section in the PPM. You know,
Yeah,
you're buying a property at a 14 cap rate, but what have you got? You got a cement block building in Santa Ana.
yeah,
Now it's a machine shop. Yeah.
right.
What happens if that
If that
cannabis
the
goes up?
licensing doesn't work or the business goes away.
Oh, that's right. And I've got a couple clients who buy a Family Dollar and Dollar General, so that's
Yeah,
fine.
yeah,
You get in a rural community and you buy yourself a cement block building, you're buying the lease, you're buying the income stream. We know all about that. But what about reproduction costs? What's the risk? And the risk right now is you really have trouble getting anything financed. So
yeah.
if
That's
you
that's
buy it
the
free and clear and something goes wrong and you need to get financing, are we going to be able to? So, and there, you know, we're not going to pitch appreciation at all.
I like that.
We're going to pitch current income for 10 years. If we can sell the building for what we paid for it, it's a great investment. I can just see the T-bar.
Yeah, yep.
Great income,
Yep.
and the reversion is just what you paid for it.
Yeah. And
Okay, it's a good deal.
and I think a lot of people, if you don't know what Gene's talking about, the T-bar, that's a fundamental part of CCIM education, where it breaks down what you invest, what you make annually, and when you sell the property, what the back end looks like. And I think I always talk about my talks is the importance of cash flow. If you just focus on cash flow, that'll guide you through the storms. When things are great, you'll win big. When things are not so great, you weather the storm. And you can't bank on appreciation. Maybe there's some things you can do to increase the upside, but you just can't bank on it. And that's, I think that gets missed a lot when the market's rolling and people are saying, well, we know we can buy it at X in a couple of years, it's going to go to Y, but you can't bank on that. And things shift very swiftly in this business. And
put on my teacher hat,
yeah.
the amount any amount of appreciation you would project 10 years from now when you discount it,
Right.
Just buy the cash flow.
It's a crapshoot, right? You don't know what's going to happen in 10 years.
It really is. What a great investment if you can stand the risk. What a great investment for an IRA. Free and clear property, no mortgage, no UBIT, and all the cash flows are tax deferred. Oof.
Well, and that's why we talk about what we're talking about, because there's a lot of opportunity. I think as we transition down the months in the ahead, there's going to be a lot of buildings. I talked about repurposing buildings, people buying, maybe like machine shops, making them cannabis shop, maybe a hotel, making it apartment buildings, retail, making it, blend of housing. I think that's going to be huge. And as syndicators, these are some of the opportunities that are out there. Now, what do you think are maybe the top 2 or 3 skill set? Because I'm glad you mentioned salesmanship, and I always talk about that. I think a lot of people have a misconception of what that is, but what are maybe the top 2 or 3 skill sets that syndicators should have?
Okay. I think they should have a good knowledge of real estate. And in the discussion we just had a few seconds ago that you and I both knew about, we learned all that stuff through our education. Right. And so why wouldn't you want to invest with a syndicator who has that stuff? And from my viewpoint, why wouldn't you as a first-time syndicator want to hear an attorney talk about how this be a great IRA investment and the benefits of this investment over a multifamily property that's 80% leverage with your IRA? You want someone. I mean, I went through a lot of attorneys when I was a syndicator before I finally found someone who knew something about real estate. Okay. Right. And so I think that's important. So I think you better have a pretty strong real estate background, as long as we're talking to real estate people. Yeah. I mean, if you're going to be in medical equipment, it's something different. But let's invest with someone who has a strong real estate background. And number 2, let's invest with someone who's going to be diligent about communications. Communications. You said it yourself. Even if there's nothing going on, You got to call them, tell them there's nothing going on.
Yeah.
Everything is good. In the old days, I'll tell you, Steve, in the old days, I used to go out to where we were building storage and we were using poured concrete. And I used to go out there with my Instamatic camera and take pictures of 10 cement trucks lined up, pouring concrete, run to the camera shop, get 30 copies of it, put them in an envelope, and send them to my investors and tell them, look, we're pouring concrete. I told you we were. And we're not pouring it in my backyard. We're pouring it at the at that syndicate, at the
right. Well, that's
now it's a little different. I have clients who do multifamily, Steve, who put cameras in their properties with websites, dedicated websites, so that anytime an investor can go online and can look at the project, maybe the common area, that's amazing. So you have to be able to communicate. And then I think you have to be a good steward of other people's money.
Yeah.
Never forget that it's other people's money. And I tell the story, if I'm going to buy an apartment building in Northridge, California, and I'm going to buy it myself, I certainly have the ability to say no to earthquake insurance.
Right.
But if I'm going to buy it with Steve's money, I'm saying yes.
Yeah.
You know, because I don't want to be in the stand and have some attorney say, you know, Mr. Trowbridge, wouldn't that have been the reasonable thing for your 40 investors to buy earthquake insurance?
Oh, I'm glad you mentioned that. I just was talking to someone else with all these fires that we have in this state.
Right.
I was talking to my kids about when I lived in Oakland in '89. We had Loma Prieta earthquake. And for about 2 or 3 months after the earthquake at school, every Friday, we'd all have to go to this earthquake drill, get under the desk and talk about our earthquake package. And and you mentioned earthquake insurance. A lot of Californians don't have it. And especially, I mean, some places are not on the fault line. You mentioned Northridge.
That's the best place to mention it.
Right. And and then like places, the Bay Area, we have multiple fault lines here. So it's something to think about when you're putting groups together, particularly because it's always better to be safe than sorry.
The simple standard, I mean, I could go through loyalty and duty of care and all that stuff, but the simple standard a syndicator is held to is that what the prudent businessman would be doing, investing other people's money?
Right.
Is that the standard in your community? And I remember I was in the Salt Lake City airport watching the World Series on television when the earthquake hit. And I was supposed to fly back through San Francisco on my way home.
Oh, wow.
Many years ago. You remember that? Wow, that's scary. So that's what I think.
Well, I think that's huge. And you guys listening, please take heed because, we've talked about some of the key fundamentals, keys to success, some of the pitfalls, the skills you need to develop. And you've got a lot of us as investors and entrepreneurs, we're very ambitious. We're very positive. You just got to making sure you cover the downside risk. And on that note, Gene, I think also having a great attorney as part of your team is very, very critical. At what point should someone engage you in their transaction? So say they've got their education, they're ready, they've identified a property, maybe got it under contract. At what point in time, should it be at the very inception of the contract during due diligence, or what's, ideal to come to you and say, hey, I've got this investment. Now I need to package it up and get it going.
Okay. I have 3 groups of people who come to me. One group waits till the purchase and sale agreement is fully executed. And then they come and then they're in a rush. Okay. Because now they're into the financing contingency period. And I have to have my booklet out to them about the same time that the bank says, yes, we'll give you a loan and you have to remove your financing. Okay?
Yeah.
Then there's another group, probably the biggest group I have, and I train them, to do this, is hire me when you get your letter of intent negotiated and you're pretty sure you're going to go into the purchase and sale agreement. And one of the things we have for rookies in our company is our fee agreement calls for, you sign the fee agreement, you pay me up front, I'm going to do the work. But if the deal falls through, All the work I've done is still right there. I've got your money, and we'll wait till the next deal. We'll pick up where we are, and we'll go forward. It won't cost you anything else, but I want to get paid for the work I've done, and then we can go through it. Not every attorney does that. So
Yeah.
I do that because I'd really like people to get with me at the LOI stage. Now, Steve, I don't do any real estate work. I'm
Yeah.
not going to analyze your LOI. I'm not going to talk to you about your purchase and sale agreement. And for the most part, my clients aren't doing real estate in California, so I couldn't do it anyhow because
Yeah.
I'm only a California real estate attorney. So that's good. And then there's a third group, which I've seen more and more of. People come to me and say, I want to be a syndicator. I know I'm going to need a manager entity. Let's form that right now so I can go out and make my offers in the name of, in my world, it was Trowbridge Equity Group and or assigns, and not put Steve Peterson on the purchase agreement.
Right.
Not go to escrow with Steve Peterson. Let's get this entity formed. And in our world, we do that quite often. They get the entity up, they get the bank account open, and they do their business cards, and they're ready to go.
That makes sense. That seems to be as I'm just listening to you, that or the LOI stage seems to be the wisest way to do it, because once you get in the contract, and that's why I asked, like, what's the optimal stage? Because once you get in the contract, now the clock is ticking, and you've got a lot of things to manage. I mean,
Right.
raising the money, but then also dealing with the financing, also doing the due diligence. You might get into due diligence and figure out, hey, these numbers are
Right.
not adding up, right? And maybe it's not a feasible deal. So, but that if you're committed to doing it, I like what you said, hey, you engage you as an attorney, and if this one doesn't work out, we can move on to the next one.
Sure. And sometimes it takes people 6-9 months to find the next property.
Yeah.
But then they call me and we're up and running. So I think that's good. So I'm looking at the time, and let's have some questions.
Yep, absolutely. I know we have a couple of them. Okay, so I'm going to go. There's Torsten Galley has asked, what cap rate do you need to be able to offer attractive returns to investors?
I'm not going to answer that.
Yeah. So,
but the property pays for everything.
Yeah.
Yeah. Here's the property, the price, the cash flows, and the sale price. All you can do as a syndicator is divide that up between the bank, you, and the investors. There are some properties that can't be syndicated because there's not enough in it for everyone. You can't syndicate a Walgreens that you're buying at a 3 cap rate with a flat lease for 30 years. You need one person to buy that because there's no room for the syndicators to make any money. So I don't think so. But a little different answer in my world, which is primarily apartments, mobile home parks, RV, and self-storage. If you can come out today with a 6% cash on cash and tell people that on a before tax basis, if it's a stable property, we can get you a 12 to 15% return over 5 to 7 years. That's saleable. If it's a renovation where there's no cash flow to distribute, you're only looking at the upside. Cash on cash isn't an issue because there isn't any. You probably need to up that yield to 15 to 20% in maybe 3 to 4 years. And those numbers will sell in my world today.
And Torsten, I hope you get that, because he's breaking down the economics that are saleable. And I think what I'm gathering from what you said, Gene, it's not about a specific cap rate, if you will, but it's really about making sure that there's enough on the meat on the bone that the investors can like, it's going to be hard to syndicate a 3 cap, especially if you got to go out and get financing on it.
Right. Very difficult. And, with positive leverage today, cash on cash is a little higher than the cap rate. So that's fine. So that's really not the answer. You have to look at the investors look at cash on cash. They look at holding period. And Steve, they look at the reversion. Some people quote where you're gonna double your money in 10 years. That's fine.
And Torsten says that's very helpful. And and he also mentions the cap rates are leaning the Bay Area. Yes, they are. Now that changes from time to time, but in 2020, not the ideal cap rates today in the Bay Area.
That's why a lot of my clients go somewhere else. You know, if you took a map and you looked at, you know, Arizona, let's see, I don't know how you're looking at it. Arizona, New Mexico, Texas, Alabama, Georgia, Florida, the Carolinas. That's where most of our syndicators are buying properties. We do have some people up in the Missouri and Kansas area. I have one syndicator who's really into Cleveland and the Cleveland area, but not so much in California, especially in multifamily.
Well, it's very tough, you know, for sure. And Torsten also asked if you have foreclosure experience. I think that's probably, we all have, you know, either dealt with foreclosures at some point in time, especially in the last market. So I'd imagine, I'm sure you worked
You're
on.
not a man if you haven't had a foreclosure.
Hey, that's the reality. You know, so absolutely, Torsten, he has. Now, and Karen Gordon Brown asks, do I still need a subscription agreement, although the details are already specified in the operating agreement?
Yes. The subscription agreement is like the offer that the investor is making to you. Hey, I'm willing to invest 50 units, $50,000 in your offering. Will you accept me or not? And in support of me, here comes the offeree questionnaire that tells Gene about the investor. Is this an investor we want in our deal? Does this investor meet our suitability standards? Yes, you really need that. And actually, the way I draft my documents, I don't have the investor sign the operating agreement. Just the manager signs the operating agreement. My investors sign the subscription agreement, which says that they attest to the fact that they've read everything and they understand, they've asked all the questions, and this one signature covers everything. Just a little easier on paperwork.
Very well said. Very well said. That's it. So it's still very important that Karen, make sure you reach out to Gene, and we'll make sure we get all your information out to everyone. And then Mike Bonadillo asks, and I wanted to get to this, but we got behind a little bit. But he asked, give us your thoughts on opportunity zones and self-directed. I guess that means something.
Well, I think opportunity zones are great, and from what I'm listening to right now, they may very well expand the opportunity zone program.
Wow.
To drive more money into opportunity zones. It might be great. Now, if the question was, what do I think about investing IRA money in opportunity zones? I don't know if I have a specific analysis of that question.
Well, I think he was asking more because he said self-directed. I don't think IRA. Mike, maybe I'm wrong, but I think he was thinking about in terms of you as an individual setting one up. Because say somebody sells a business or something, you can go into another fund, but you can also possibly set one up yourself.
Set up yourself. One of the things about an opportunity zone, it's a way to get your money out of non-real estate into real estate. We had a client who sold an optical company down here in Irvine, millions of dollars, but wanted to buy real estate and defer the gain. Okay. And there's no way you can go from selling your stock in a company to buying real estate. You know that doesn't qualify for 1031, but in the opportunity zone, you can put your money in there. So I think that's great. My only problem is we've done quite a few things in the business since I've been in the real estate business that have motivated people to do things tax driven that they wouldn't have done if it wasn't for the taxes. And now we're asking people to go into areas for one reason or another that they probably would not have invested in before. Just because there are tax benefits doesn't mean it's a good investment. And the most recent thing was, oil back in the 80s when we could invest in Houston and all that stuff. that didn't work.
Yeah.
It still has to be a good investment. And there are a lot of good investments because there's a lot of, the most opulent courthouse in the United States is the Ronald Reagan Federal Building down in Santa Ana, which is surrounded by opportunity zones. Why wouldn't you go in there and take something and build a little office building for attorneys who practice at the federal courthouse? Why wouldn't you do that? And then why wouldn't you buy the corner and put a sandwich shop on it so the attorneys have a place to eat, and then the other corner and put a bar in there so they can all get drunk together at the end? What the hell? Why wouldn't you do that?
Right.
Especially with some tax help. So I think it's a question.
But I like what you said, is that don't just do it for the tax benefits. It still has to be economically viable. And I say the same thing with 1031 exchangers all the time, is that we got to make sure that you're buying a better investment, not just deferring taxes.
Right.
And I learned that from my buddy Ron Ricard from IPX. He always said that you're exchanging to go into a better asset. The deferral of the taxes is an added benefit. And
I heard you say on your podcast that the issue is the money you have in this property doing the best thing it can do for you, or would it be better in another property? And that's the answer. That's a disposition question. And then the question is, once you've decided, no, I need to move my money, is an exchange the right play? One of the things I've always thought about is a lot of people get stuck in the exchange rules to defer not quite enough gain. It isn't really worth it to defer $200,000 in gain and go through 45 days and 180 and pay the damn tax.
Yeah. Well, because then you can do what you want to do. If you have $2 million, it might be different, but $200,000, you're only saving 40. Yeah, it may be worth the hassle. So I think that's key. And I'm looking. I think we're done on questions. I know there was a couple people. I know Bonita Wright had raised her hand. Bonita, if you're still there, if you want to quickly chat something in, I don't see a question. But Gene, what is the best way? I know I'm looking at a few people here that fit your description as, kind of first time syndicators.
Rookies.
What is the best way for people to reach out to you?
Well, right behind me, Gene at trowbridgelawgroup.com. That's our general number. If you call there, I'll get the call. And our website, Trowbridge Law Group, has all the social bells and whistles, and we do a lot of great things on our website. I did a webcast this morning on the sources and uses chart in a PPM. Jonathan and I every week do something called TBD with TLG. We get together about 10 minutes before the show and we talk about questions we've had during the week, and we pick one and we spend about 20 minutes answering the question. Wow. That's why it's called To Be Determined. And then we're going to start with some interviews after October, starting to interview people on who are clients of ours who've done syndications and have stopped doing syndications. Very interesting conversation with the people who've stopped. Very interesting.
Well, yeah, and I think I'm sure there's going to be some great success stories, some horror stories, some in between. And I think the biggest thing for you guys and all of us is we got to swing the bat. And if you make a mistake, get back up and keep going. But learn from the experts. And that's a big part of what I want to do in bringing content is this is expert level content, you guys. So when you reach out to Gene, make sure you know this is the best in the business and you want to get the best on your team.
Right. And our consultation, if you go to the website and sign up for a half-hour consultation charge, it's free. I want to congratulate you for, the leadership you've provided locally for the CCIM group and probably other real estate groups in your area that I don't know about, and doing all this, wearing your pin.
I appreciate it.
If it weren't so hot where I'm sitting, I would have had my sport coat on, and I've got a great big, where is it? I guess I don't. I thought I had a great big pin, but I don't. Anyhow, I do own a sport coat. But anyhow, so thanks for having me. I appreciate it. And maybe in a month or two, we want to delve into one or two other areas that
Yes,
I'm
yes, I
strong
think
on.
that would be.
Call me.
I had a bunch of stuff on opportunity zones, but we got into this thing, and I'm sitting here and taking mental notes myself because I'm learning a lot, man, and I really
Okay.
appreciate your time reaching out to me. We should set up another one. That would be honored to do that again. And please, you guys, go to Gene's website, call him, send an email, get involved in this business, take the bull by the horns, but do it in a way where you got education, you're guiding yourself with education and a team that's in place. So really
Thank
appreciate you guys. Thank you, Gene.
Thank you, everyone.
Thank you so much, you guys. And we'll look forward to seeing you guys on the next one. Everybody
Okay,
have
be
a great
safe. Everyone be safe.
Thanks, Gene.